On February 17, 2026, New York City Mayor Mamdani stood at City Hall and presented what he described as a last resort. Facing a budget gap of $5.4 billion, with Governor Kathy Hochul refusing to raise taxes on the wealthiest individuals and corporations, Mamdani placed a specific number on the table: a 9.5% increase in New York City property taxes. It would be the first property tax rate hike in the city since 2003. It would affect more than 3 million residential units and over 100,000 commercial buildings. And it arrived on top of a property tax system that the city's own officials, economists, and community advocates have described for decades as fundamentally broken, one that already charges homeowners in predominantly black neighborhoods effective tax rates that can be double what homeowners in primarily white neighborhoods pay for comparable properties. The 9.5% figure did not emerge from nowhere. New York City's fiscal year 2026 budget totals approximately $115.9 billion in expenses. After accounting for all revenues from sales taxes, income taxes, state and federal aid, and other sources, the city faced a structural gap of roughly $35.2 billion that needed to be covered by property tax collections. Property taxes are the city's single largest revenue source. Approximately $33 billion of the city's recent budgets has come from property tax collections. The gap between what those revenues produce and what the city needs to spend has been widening. City Comptroller Mark Levine, in an interview following Mamdani's announcement, acknowledged that the city faces the biggest budget gap since the Great Recession. Mamdani attributed a significant portion of that gap to under-budgeting by his predecessor, former Mayor Eric Adams, whose administration, he said, left financial commitments larger than those during the 2008 and 2009 financial crisis. The mayor also said that even after identifying $1.7 billion in budget savings through his administration's analysis, the remaining gap could not be closed without either new revenue from Albany or a property tax increase. The reaction to the 9.5% proposal was swift and negative across the political spectrum. City Council Speaker Julie Manine and Councilwoman Linda Lee, who chairs the Council's Committee on Finance, released a joint statement saying both the property tax hike and a proposed draw on the city's rainy day reserves should not be on the table whatsoever. Queens Borough President Donovan Richards called it a non-starter. City Comptroller Mark Levine described the proposal as a very big mistake and characterized the existing property tax system as unequal, with a heavier burden on working-class homeowners, especially in communities of color. Deputy Council Speaker Natasha Williams, who represents predominantly black homeowners in southeastern Queens, said advancing a tax increase without first addressing the structural inequities in the system felt deeply tone-deaf to the families she represents. A homeowner in Addisley Park in southeastern Queens, speaking to the city, described her reaction as flipping out and warned that a mayor who actually implemented the hike would be a one-term mayor. Andrea Scarborough expressed what many homeowners in the outer boroughs felt, that raising taxes on working-class constituents in response to a budget problem those homeowners did not create was a political miscalculation of significant proportions. Governor Hochul's response was equally direct. She told reporters she did not think a property tax increase was necessary, and reiterated her refusal to raise income taxes on high earners, a position she had held throughout the budget negotiations. On the same day she rejected the property tax hike concept, she announced an additional $1.5 billion in state funding to help address the city's budget gap, including more than $500 million in recurring funding, which reduced the gap from the figure cited the previous week. The interaction between Mamdani and Hochul was described by political analysts as a game of chicken, with the mayor presenting a worst-case scenario to create pressure for a negotiated compromise, and the governor refusing to blink. Timothy Weaver, an associate professor of political science at the University at Albany, told ABC News that by presenting the worst-case scenario, Mamdani was laying the foundation for a potential compromise that might include smaller tax adjustments on both wealthy individuals and homeowners, allowing the mayor to claim he had avoided the worst outcome. The parallel to Boston's 2025 experience, where Mayor Michelle Wu made similar demands of the Massachusetts state legislature before a budget compromise was reached, was noted by several analysts. The deeper issue that the budget confrontation exposed is not the specific 9.5% proposal, which faced enough opposition that its enactment in that form appeared unlikely, but the underlying structure of New York City's property tax system, which has been described as broken by every mayoral administration since at least the 1990s, without any administration successfully reforming it. The current framework was established in 1981 through state legislation that divided New York City properties into 4 classes and set specific rules for how each class is assessed and taxed. Class 1 covers 1, 2, and 3 family homes. Class 2 covers cooperatives, condominiums, and rental apartment buildings. Class 3 covers utility-owned property. Class 4 covers commercial and industrial properties. Each class pays a different effective tax rate, and the apportionment of the total tax burden among classes is governed by rules that have not been fundamentally updated to reflect how the city's real estate market has changed over the past 4 decades. The inequities that result from this framework are substantial and well documented. A 43-unit building in West Harlem with rent-stabilized units pays approximately $71,500 per year in property taxes, representing about 1.6% of its total assessed value, while a single-family home next door worth $4.2 million owes just $12,200, or approximately 0.3% of its value, according to a 2025 report by the Community Service Society, an anti-poverty nonprofit. This disparity is not an accident of the market. It is a structural feature of how the 1981 state law and subsequent regulations have functioned over time. Assessment caps on Class 1 properties, limiting annual increases to 6% per year and 20% over 5 years, have dramatically slowed the growth of tax bills in neighborhoods where property values have increased most rapidly in recent decades, including Park Slope, the East Village, Harlem, and Bedford-Stuyvesant. In these neighborhoods, the effective tax rate, the tax bill as a percentage of market value, has declined as property values have risen faster than the capped assessments. Meanwhile, homeowners in lower-income parts of southern Brooklyn, the East Bronx, and eastern Queens, where values have grown more modestly, have not benefited from the same dynamic. Their assessed values more closely track market values, resulting in higher effective tax rates relative to their home's worth. The luxury condominium and cooperative market adds a separate layer of inequity. State law requires the New York City Department of Finance to determine market value for co-ops and condos based on the rental income those buildings would generate if they were rental properties. This methodology systematically undervalues expensive co-ops and condos because the comparison rental income is drawn from a broad category of apartment buildings that includes rent-stabilized units worth considerably less than luxury apartments. The result, as explained in an analysis published by the city, is that luxury homes are compared to a category that includes rent-stabilized units worth much less, producing artificially low tax bills for high-value properties. Because all apartment buildings are within the same tax class. When some buildings in the class pay less than their market value would suggest, other buildings in the same class bear more of the collective burden. This means rental buildings, whose landlords pass tax costs to tenants through higher rents, are effectively subsidizing the relatively low tax bills of luxury condominiums. Rent in New York City's housing market is not only a function of supply and demand, it is also a function of how the property tax system distributes costs across different categories of buildings. Mayor Adams, before leaving office, had developed a proposal to address some of these inequities. The Adams plan would have raised the assessment caps on 1 to 3 family homes from 6% annually and 20% over 5 years to 8% annually and 35% over 5 years, and would have reset a home's assessed value to a standard 6% of market value upon sale. The plan included tax relief for lower-income homeowners, offering reductions worth up to 25% of assessed value for households earning below approximately $107,000. According to city estimates, the Adams plan would have reduced tax bills for approximately 275,000 homeowners with a median savings of around $960 per year, while raising taxes on approximately 168,000 homeowners with a median increase of $701. Bill increases would have been concentrated in Manhattan and parts of northern and central Brooklyn, while the largest decreases would have occurred in the East Bronx, eastern Queens, and southern Brooklyn. The bill failed to advance in the state legislature, where it would have needed approval because New York City's property tax system is governed by state law and cannot be changed by the city alone. Mamdani campaigned on more comprehensive reform than what Adams proposed. His administration's stated model is the recommendations of a 2021 Commission on Property Tax Reform convened under then-Mayor Bill de Blasio, which called for fully eliminating the assessment caps rather than simply raising them, a more far-reaching change that would produce larger shifts in tax burdens across neighborhoods. The city's budget director, Sheriff Soliman, said in late February 2026 that property tax reform legislation would be introduced to state lawmakers within weeks. The political challenge facing Mamdani is the same one that stopped every previous attempt at reform. Comprehensive changes to New York City's property tax system would raise some homeowners' bills, and the state legislators who would need to approve those changes are acutely sensitive to constituent reactions to tax increases, particularly in neighborhoods where property values have risen and where homeowners who have lived in those communities for decades could face substantially higher bills under a reformed system. The FY27 tentative assessment roll, released in January 2026 by the New York City Department of Finance, showed total market value of all city properties at $1.659 trillion, a 5.4% increase from the prior year. Taxable billable assessed value, the portion of market value to which tax rates are actually applied, increased by 5.6% to $325.8 billion. Class 1 properties, the 1 to 3 family homes, saw their taxable assessed value increase by 5.8% citywide, with Staten Island homeowners bearing the largest increases at 7.8%. Brooklyn's Class 2 rental apartments saw taxable assessed value increases of 14.2%, the largest of any borough in that category. For a homeowner with a property assessed at $500,000 in Class 1, the 5.8% increase in assessed value translates to an additional $1,450 to $1,150 in annual property taxes, depending on the applicable rate. For a condominium owner assessed at $400,000, the impact ranges from approximately $1,168 to $1,804 per year in additional tax. Outside New York City, the picture looks different, but is not without its own pressures. New York State Comptroller Thomas DiNapoli announced in July 2025 that the 2026 property tax levy growth for local governments operating on a calendar fiscal year would be capped at 2%, the same level for a fifth consecutive year. This cap, established by state law in 2012, limits annual increases in the total amount of property taxes local governments can collect to the lesser of 2%, or the rate of inflation. The 2026 inflation factor was calculated at 2.64%, meaning the 2% cap was the binding constraint for calendar year local governments, including all counties, towns, fire districts, 44 cities, and 13 villages. DiNapoli noted that the challenge for local governments is maintaining essential services within this cap while dealing with higher prices for commodities and services, and the potential impact of policy changes at the federal level. In Elmira, the City Council struck down an amendment that would have reduced a 12% property tax increase proposed in the city's 2026 budget, an indication that even in upstate communities operating under the tax cap, specific local fiscal conditions can produce proposed increases that exceed the state cap through the override process available to local governments under certain circumstances. The SALT deduction change enacted at the federal level in 2025 provided some relief for New York property owners facing high tax bills. The federal cap on deductions for state and local taxes was raised from $10,000 to $40,000 for taxpayers with income below $500,000, or $1 million for married couples filing jointly. Before the change, over 25% of New York State taxpayers did not receive the full benefit of the SALT deduction. That figure dropped to approximately 2.5% following the increase. For New Yorkers paying substantial property taxes, the expanded deduction creates an opportunity to reduce federal income tax liability by an amount that partially offsets the cost of higher local tax bills, though the benefit depends on each taxpayer's specific income level, filing status, and total itemized deductions compared to the standard deduction. The property tax situation confronting New York City homeowners in 2026 involves simultaneous pressures from multiple directions. Rising assessed values in a tentative role that reflects continued strength in both residential and commercial real estate markets, a mayor proposing a 9.5% rate increase as a budget tool, a structural system that economists and officials across the political spectrum agree is inequitable, but that has proved politically impossible to reform for more than 4 decades, and a state-level negotiation between City Hall and Albany that will determine whether any path to fiscal stability can be found without placing additional burden on property owners and renters. Further developments are expected as Mamdani's administration introduces property tax reform legislation to state lawmakers as the FY 2026 budget negotiation between the mayor, the City Council, and Albany proceeds toward its June 30th deadline, and as the question of whether New York City's first property tax rate hike since 2003 will ultimately be enacted or avoided is resolved in the months ahead.